Infinite banking. This video is going to explain compounding versus simple interest and the other two types of interest. Interest is interest, right? We want to earn the most and pay the least for sure. But there are four types of interest, and the type of interest applied will make a significant difference in how much you will earn or pay depending on the application. Why it's important to infinite banking? Because with an infinite banking policy, you are earning compounding interest while policy loans are assessed simple interest. So in this video, I'm going to explain and show you the difference between the two types of interest and the advantage that you gain with these differences. But stay tuned because I'm also going to show you what's up with amortized and revolving interest as well. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategies, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For over a decade, I have focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategies. So now let's get to the good stuff. And if you find this to be helpful, please like this video and subscribe to this channel and share it with your family and friends. Also, please post your questions and comments here. You have questions, we have answers. All right. Now, I want to keep this simple and easy to understand. So let's start with the simplest form of interest. Simple interest. Simple interest is a percentage rate that is charged on the principal loan amount. So if the loan is for $1,000, that is the principal loan amount. And simple interest is charged on that amount. So if the interest rate is 5%, the interest charged for that loan will be $50. Simple. But, sorry about that. If the loan is scheduled for more than 1 year, say for example 5 years, then that 5% will be multiplied by 5, the term of the loan. In that case, simple interest of 5% on a $1,000 loan will be $250 over the 5 years. Now, in the case of a policy loan, the simple interest is always calculated for just 1 year. So if you don't pay off the entire loan in the first year, interest will be calculated on the remaining principal loan balance, but not the principal plus the unpaid interest. Okay? So in that case, if half the principal is paid in the year, leaving a principal balance of $500, even though you only paid half of the interest charged for that year, meaning the total balance is $525, principal balance of $500 plus $25 unpaid interest, $525. The next year's interest charge will be just $25 because the interest is charged only on the remaining principal loan amount, which is now just $500. It will be added to the remaining total balance of $525. So now the total balance owed will be $550. Now, this is unlike compounding interest because compounding interest adds the interest paid to the principal and then interest is charged or paid on that total. So in that case, if your loan balance is $525 at the end of the year, including unpaid interest, compounding interest of 5% would add $26.25, making the total due $551.26. But looking at the infinite banking account, if your cash value is $1,000 and the dividend interest rate is 5%, the interest paid to your account will be $50 the first year, giving you a total of $1,050. Then the next year, your compounding interest will be $102.50 because the interest paid on the total of the principal and the interest paid previously. And so the interest, the dividend interest is paid to your account on that entire total, including the balance, the interest that you gained from last year. Sweet, yes? And by the way, the current dividend interest rate with my preferred provider is 6.1% compounding. And the highest policy loan rate with them is just 5.85%. Simple. So the advantage of taking policy loans here versus a bank loan, including credit cards, is pretty obvious. Now let's consider amortized and revolving interest. They're kind of similar to each other in that the interest is charged on the remaining balance at the end of each payment period, in the case of revolving, and at the anniversary of the loan in the case of amortized interest. However, with amortized interest, the balances are calculated for the total length of the loan, and the interest charged is also calculated on those balances and then added to the beginning of the loan to arrive at the total to be paid. And that's why mortgage loans that are set for 30 years have you paying almost the same amount of interest as principal over the term, and nearly doubling the amount of what you will have to pay over the 30 years. That's also why with amortized loans, your payments are split between the principal and the total interest charge. And in the early years of an amortized loan, you'll be paying much more against the interest charged than against the principal. And as time goes on, your payments will gradually begin to pay more against the principal and less against the total interest. So with amortized loans, such as mortgages, it can be helpful to make extra payments against the principal if you can, as that will lower the total amount of interest loaded onto the loan. Now, revolving interest is a little different. Most common types of loans that charge revolving interest are credit cards and lines of credit, such as personal lines and home equity lines. Revolving interest works this way. Typically, it's really interesting. Typically, there will be an assigned billing cycle, usually 1 month. Interest is charged and added to the total loan balance at the end of the billing cycle. But the way the interest is figured is by taking the interest rate as an annual interest rate, then dividing it by 12 for the 12 billing cycles in the year. Then it's further divided by 30 or 31, depending on the number of days in the billing cycle. Then that amount is added to the total balance at the end of the cycle. But that's based on the daily balance. So let's say you have a personal line of credit or PLOC, and keeping with the numbers we've been using, we'll say the revolving interest rate is 5% annual. Your loan balance is $1,000, again, as with the previous examples. You haven't made a payment until the due date at the end of the cycle. So the interest is figured at 5%, which is $50. That's now divided by 12, which makes it $4.17. Because the balance was the same for the entire month, that's all that gets added in interest for that cycle, $4.17. But when you make your minimum payment of $20 at the end of that billing cycle, your balance drops to $984.17. Now, let's say you make another payment mid-month, another $20, dropping your balance to $964.17. And it stays there until the end of that billing cycle. Now the interest gets calculated this way. $984.17 times 5% divided by 12 months equals $4.10. Now that gets divided by 30 days for that month, and that comes to 14 cents. That's multiplied by the 15 days the balance was at the $984.17, and that equals $2.10. Then the lower balance of $964.17 is multiplied by the 15 days that remained of the billing cycle. That's 964 and 17 cents divided by 12 divided by 15, and that comes to $2.01. So the total revolving interest for that whole billing cycle comes to $2.10 plus $2.01, or $4.11, a little less than any of the other methods of interest. Now, here's the comparison chart. But for this, we'll use numbers a little closer to what we might actually deal with in our infinite banking. We'll use a loan balance of $10,000 and an interest rate of 6% over a 10-year payment term. Okay, I'm going to share my screen. Wait now. Here we go. Here we go. Now, these numbers are from an interest calculator you can find online, and these numbers assume that the $10,000 loan is paid off in the 10-year period at a scheduled payment amount per month, except for the compounding example, which is an interest earned calculation, because we're relating to infinite banking, and your policy cash value is earning compounding interest. Clearly, the highest interest paid is the compounding interest at 6% over 10 years. The interest earned adds over 79% to the total. Simple interest adds 60%. Amortized interest adds over 33%. And revolving interest adds only 10.6%. It's pretty obvious that compounding interest is what we want to earn, and revolving interest is what we want to pay. And we can clearly see that when earning compounding interest, even when being charged simple interest on loans, and even if it were the same rate as what we earn in compounding interest, we would still come out ahead in positive gains. This has been the simple overview of interest types. I hope it was easily understandable and helpful. And if you found this to be helpful, please like this video and subscribe to the channel and share it with your family and friends. Also, please post your questions and comments here. You have questions, we have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below the video here. The link to buy my books on Amazon.com is also below. If you'd like to book a free phone consultation with me, the link to my Calendly page is also below. If you'd like to apply to become a client of ours, the link to the application is also below. We're here to help, and we look forward to helping you. Aloha and mahalo for watching.